welcome Uday Goyal.
Hi, good afternoon, everyone, and welcome to this session, which is called Financial Inclusion, Increasing the Pace. And I think the inspiration for this session actually came for those of you who were at Sibos 3 years ago and watched Bill Gates' opening keynote, where he talked about financial inclusion being the next big thing for the Gates Foundation. And I think what we want to try and encompass with actually a group of really very well-qualified people on this table is to talk about how things have changed from then until now and what is going on with banking the unbanked. And I just want to make an observation because I was watching the earlier session on identity, and identity is such a key part of inclusion, that there's a great divide, I feel, between the developed world and the developing world, which we were talking about, where identity becomes a great enabler in the developing world and seems to be sort of an inhibitor in the developed world, which strikes me as an interesting sort of place to think about things. And so in that context, as I said, we have a great group of people. And what I'm going to try and do over the next 7 or 8 minutes is maybe give you a little bit of an introduction to regulation and some of the other aspects and how it started to change financial inclusion in these markets. And I work across 2 big markets in financial inclusion. I'm an investor. I invest in companies that are enabling financial inclusion. And in those 2 markets, which is Africa and Asia, there are 2.9 billion people. And approximately 2.2 billion people don't have access to formal financial services. Now, I see that not only as something necessary to bring people into that market, but I also see that as a huge business opportunity because it's a grand untapped market that none of us are really thinking about. And so I think as you listen to what people have to say here today, think about that as well. So I just wanted to cue up the Prezi. So if you think about financial inclusion, whilst there's been significant progress towards financial inclusion, continued significant challenges remain. So let me run you through those. There are about 2 billion people around the world who don't even have a basic bank account. Some groups are significantly more excluded than others. We can think about women, the rural poor, people in remote areas that have little access to infrastructure. A lot of small enterprises lack the credit and the collateral to be able to finance themselves and to get working capital. As you know, small enterprises are really the lifeblood of most economies around the world. More than 200 million informal and formal MSMEs lack access to any form of funding. And actually, the one that surprises me the most out of the statistics is almost 60% of adults without an account around the world cite the main reason they don't have an account is because they can't afford it, which is a very interesting psychological thought when you think about money. So that is despite the fact that financial inclusion is now a #1 priority for most governments around the world, for good reason. Talk about the Gates Foundation, and Costa will talk to you about that. There's the G20 Financial Inclusion Action Plan. There's the Sustainable Development Goals. All of these things have made financial inclusion a cornerstone of where they're going forward. However, these global directives actually need to be supplemented by a change and support both from local regulatory authorities and governments around the world. Historically, if you think about governments, they really think about the inclusion problem broadly in 2 ways. The first way, and I'm from India, and this was something that happened in India many years ago, is to either go out and nationalize banks or actually coerce financial institutions into servicing the poor. And I'm sort of fundamentally opposed to that because I think if you don't build sustainable businesses that are profitable, you can do that for a while, but when you turn the tap off, basically the water will stop coming out, and that's actually what's happening. The other thing is actually to do nothing more than the occasional gentle nudge. So they've been touching a few levers here and there, and economic growth has actually suffered as a result. So how do we think about that? Now, to me, this is always fundamentally the chart that everybody should remember, which is a regression analysis that looks at the level of financial inclusion within economy and GDP. And as you can see, there's an absolute correlation with that. So I would hazard a guess, I don't know exactly, the guys on the right are the Nordic countries with extremely high GDP and close to 100% financial inclusion. The ones on the left are the poorer countries, and as you can see, as you go further down. And that's very important. There's also another statistic which I often use, which was done from a BCG study, that every 1% increase in financial inclusion actually results in a 3.6% increase in GDP growth. And that's actually correlated and well documented. So these are all real documented facts. So if you think about that, one of the things we started to see is that regulators in these emerging markets have been proactively seeking to tackle this problem. Although in different markets, this approach actually differs. So if you think about that, one of the things that me and my co-founder of APIS Partners, we put together this paper, which for those of you who want to read it, you just Google APIS Partners and Financial Services Cambrian Explosion. You can download it off the web, which effectively looks at how these growth markets have been innovating for the next 2 billion customers. And what I wanted to do is maybe give you those insights. And we really looked at 5 markets. The 5 markets we looked at were India, Nigeria, South Africa, Kenya, and Indonesia. And they're all sort of slightly disparate markets and slightly different phases of development, but they all serve to give an interesting point of view, slightly differing point of views in each of those markets. So there are 6 distinct, what we found was there are 6 distinct enablers that measure regulatory intervention and attitudes towards financial inclusion. The first one is, to me, probably the singular most important one, and this is why I was fascinated by the earlier discussion around identity, because KYC and AML is actually the cornerstone around financial inclusion. You have to actually be able to identify people to bring them into formal financial services. I think the country that's done the most in this has been India, which has created a national biometric database and actually has more than 1 billion people stored in that database and has effectively solved the KYC problem in one fell swoop. However, the thought from a more developed market context of everybody's biometric information being stored in a central database, and as you were hearing in the earlier session, subject to potentially being hacked and your identity being stolen, these issues don't exist because, in fact, in these countries, these are real enablers. So something for people to think about. The second thing is around financial infrastructure, and one of the things that a lot of these governments have pushed out is last-mile touchpoints for distribution, and they've really used ATMs and point-of-sale devices to do that. They've used agent networks in the first instance to do that, and soon, and very soon, that will transform itself into the use of the cell phone as the ultimate last-mile distribution touchpoint. Next, of course, is payment systems, and Chris is going to talk a lot about payment systems, but it's very interesting that payment systems cornerstone. Creating real-time payments is almost an essential part of this, because once you're able to move money seamlessly and without a lot of friction between an account to an account, you set up a beautiful infrastructure to build lots of services on top, which actually remove a lot of the cost from the system. The use of technology, we were chatting a bit earlier about credit. How do you get credit in a place like Kenya or in a place like Nigeria where there isn't a credit rating agency, where you don't have a FICO score? How do you do that? In fact, what you see is that people are using your cell phone data, people are using your social data to put together a proxy for credit, which in some ways is even more effective than the way we give out credit in developed markets. And some of those delinquency rates from those credit systems are significantly lower. In fact, there's another paper on the side, if you're interested, called Breaking the Bank, which talks about those credit providers. So that's a big area of growth. But the one thing that people often don't think about, and this is something that I think we will have to start thinking about a lot more, is as you bring people into formal financial services, you also have to protect them. You also have to protect them against usurious lending. You have to protect them against institutions that take advantage of them. And so actually, ideas like lending caps, making sure that people's balance sheets are not over-indebted, things like data protection and protecting people from that perspective are starting to become things that we need to think about better and more as we bring these people in. And then finally, there are a bunch of general financial inclusion facilitators. For example, the idea of a universal bank account. I think Belgium was the first country in the world to create the concept of a universal bank account where everybody has to have a bank account. India is coming fast soon, because soon you won't be able to get your benefits unless you have a bank account, but because you're biometrically enabled, you can. South Africa has very high penetration of bank accounts as a result of a system that Chris is going to talk about in a bit. So we're starting to see that quite a bit. And each country has really taken a very different approach to this. So India has really focused on both the demand and the supply side. How? Well, it went out and pushed the financial institutions to open bank accounts for people. And on the supply side, it's also created, for example, a real-time payments infrastructure that allows people to actually use that infrastructure and use those accounts. They've created this very complicated digital infrastructure called the India Stack. And actually, Costa and I were joking a bit earlier, for those of you who've been coming to Sibos a few years, there's something called the Digital Asset Grid, which we presented, I don't know, 4, 5, 6 years ago, which is effectively the India Stack. So some of these ideas somehow permeate from here as well. Places like Indonesia really took a different approach. So India was quite bank-centric and financial institution-centric. Indonesia has actually started more on the MNO sides, basically, where you use the mobile networks and wallet-based approaches. And they're also in the process of creating a national switch like India has. South Africa, which has an incredibly advanced payments infrastructure, has actually created a collaboration between a private sector entity and the public sector to tackle that. In Kenya, and I'm sure all of you have heard of M-Pesa, it was actually, in a funny sort of way, regulation was catching up with what actually happened. So M-Pesa started to create itself, and then regulation caught up with M-Pesa. So it sort of went in the other way. And then finally, Nigeria, where I've been spending some time with the central bank and some of the legislators there, it's starting to become a central bank-led financial inclusion agenda. And part of that is to strengthen the digital infrastructure and, again, build real-time payments. So these themes, again, will pop up again and again. So why is it very important to examine these factors? Well, in the absence of traditional legacy infrastructure, the ones that we're used to in these emerging markets, really you need to create the presence of an enabling regulator, which then ultimately creates this environment which is ripe for building these businesses on top, which are these alternative distribution mechanisms in financial services. And so we're starting to see a lot of these interesting companies starting to build on top of these stacks that are being built around, for example, the India stack, what's going on in Nigeria, what's going on in South Africa. And that can be everything from mobile money to microinsurance and microfinance and others. So I think that's all I wanted to kind of say in terms of the opening. And then let me hand over to Christine.
Good afternoon. My name is Christine Duhaime. I'm the founder of the Digital Finance Institute, and I'm here to talk about, I guess, the toughest one of all, the AML issue, and I'm also a lawyer in AML law and private practice, so topic dear to my heart.
So Christine, we were talking earlier, and you think that actually regulation is not an enabler, it's actually quite the opposite. So talk us through why you sort of have taken that point of view, given everything I just said.
I'll start off with an example. So I'm helping a Bitcoin exchange, a digital currency exchange that lists ICOs, startup in Vancouver. And a lot of fintech companies got together to do this, and they wanted to do it the right way. And the right way to them was, look, let's not get shut down. Let's have AML as the first thing we do. So I started to map out what anti-money laundering law was with counterterrorism law, with sanctions law on a big chart for them. I kid you not, our chart is about as big as that wall. But kind of list out, if you're a corporation, these are the steps. If you have beneficial ownership, these are the next steps. If you're a person, these are the steps. And if you're, on a terrorist list, then these steps. And people come in and they're like, holy cow, how do you onboard a client in a place like Canada, around the world, when that is the law that you're asking a fintech, or you're asking, a techie to kind of comprehend and comply with? So it is complex, it's expensive, and instead of enabling us to bring technology in to service clients online, we've created this incredible legal infrastructure that makes it really, really difficult for the average person on the street to even get a bank account, including in our country. So for me, the first step is, look, let's make it easier. Let's make it possible to onboard people online. Let's make it comprehensible. Let's not, make it so difficult that people can't get bank accounts.
I mean, basically what you're saying is you're using a sledgehammer to crack a walnut, right? Mm-hmm. Because what you should be doing is tiering KYC AML to, let's say, if it's a small amount of money, then you have lower thresholds. And basically it's that's the way it's sort of built out.
Yeah, like I think there's got to be a way where it depends on the transaction or the amount, and we actually should be risk-based. That if it's people we know, if it's in a small town, we know who they are, and so the risk is almost non-existent. So why is that at the same level of banking somebody who maybe we don't know, sending money from a country that is a little bit risky? And we have the same rules for everybody, and I think that definitely needs to be risk-based.
Chris, you were going to say so.
There's a big. I'm not sure that's coming through. Hello. I'll just have to speak really loudly.
Oh, we can hear you.
So I think there's a bit of a challenge here, because while I think you can focus on the underbanked community and do as India has done, which is essentially push past that sort of regulatory framework and say, we're going to do it our way, we're going to have a biometric one-size-fits-all solution, and that you can do really quickly with strong central leadership, as India has done very successfully. But in a place like South Africa and in a number of the countries in Africa, you've got these two economies that coexist in the one country. So you've got a developed economy, which has all of the complexity and therefore the need for active risk management of a Canada or a US or a UK, and you've got a large unbanked community. And so the government has a real conceptual difficulty going, you know what, I'm just going to make those guys do that, but not make these guys do the same thing. So you've got that difficulty of reconciliation, and I'm not sure that there's a perfect answer to that.
Is there a way to solve the two-tier issue that Chris is talking about?
I think we don't, and this is like, it may sound irresponsible, but I don't think we need perfect AML, and I don't think we need perfect counter-terrorist financing. And in fact, when you look at the first FATF recommendations, it wasn't, this is the standard in the sense that everybody had to comply. It was really that if a person is high risk, these are the onerous standards. But what every bank has done now in order not to be fined is, in every country, is they've said, well, okay, assume everyone is high risk. And so then it becomes really difficult for a bank to make a decision to onboard people and give them bank accounts, because they don't want to be fined, and so they're operating from a place of fear, as opposed to just deciding, well, let's take on, let's do what I think is probably responsible and an innovative solution, which is bring on some clients with more relaxed AML.
Sorry, Costa, you were going to...
Yeah, Christine, can you unpack for us? I understand that there are two specific contexts where we should talk about AML, and I would like to look at it from a domestic perspective within a country, and then the international money transfer. So do you think that domestic initiatives suffer from the same problem of...
Absolutely. I was just in California, big financial inclusion problem in California with the immigrant population. Then here in Canada, we have First Nations, where I'm from, in Vancouver, that can't get bank accounts because they're homeless. They're drug addicted. They're in a halfway house. So because they don't have a permanent address, because they don't have a Canadian type of an ID, because it's, maybe an Indian card, as we call it, those are impediments for them getting bank accounts. So when they do get money, they go to payday lenders and pay 25% of a fee. Like, it's horrendous, every 2 weeks. And those are the people that need the money the most, and they can't get bank accounts. So even in our country, it's an issue. And when I look at statistics from the World Bank, where we talk about what the financial inclusion numbers are, they often, on those statistics, don't include people who don't belong to a country. So when they do their analysis, they look at whether or not you're a citizen, and then they do the evaluation. So they're not including non-citizens in that evaluation. So the unbanked problem is even greater in other countries. And I mean, really, I don't think the world started out on financial regulation that this was going to be something to make sure people didn't get bank accounts, but it is the result. And I think we kind of need to go back to the financial regulators and say, let's just have a rethink and make sure we can bring people into the system, because at the end of the day, it's safer to have people in the financial system where you can monitor transactions. If what your fear really is terrorist financing, then bring them in, and bring them in with a responsible innovation approach.
But I think what I just heard from you is we're back to identity, because actually the root of all of this is back to identity, right? Yeah. So I mean, say you solve it with biometrics, so you solve it somehow, right?
Sure, but you've added another really important element there, which is the undocumented community, the immigrants without papers. This is a big problem in a lot of developing economies, and there are political issues about giving rights and giving framework to those people, even though actually the logic of the economy is you should just give them the biometrics and be done with it, right?
So maybe, Patrick, because you're operating in these rural communities, how do you deal with the issue of identity and
Well, yeah. So for many of our products, we are providing end consumer financing, and in those cases, we collect people's identity as best we can. But I think we don't have as stringent of standards as a lot of companies might have in the global West, to get people's identity. I mean, and oftentimes we're selling products to people in a market visit where their ID might be miles away and they don't have a transportation mechanism to get back and forth, or they don't even have identification. So one way that people are able to be identified now is through their mobile money accounts, and that's one way that we have a touch point with the consumer. But it is a very different world.
Yeah, I mean, I think as you center down, all your social footprint and all these aspects can actually narrow down to your identity using algorithmic technology to be able to do that. And I think that's where we're going over time. I mean, there's a scarier side of that, which I think we were just chatting on earlier, which is what's going on in China right now with identity, which we'll talk about in a bit. But the whole idea of the social score in China is quite scary around identity as we get into that. I think just to move on over to you, Costa.
Right. So, hi everyone. Let's talk a little bit about this notion of mobile money, just to unpack that a little bit for the audience, just to make sure everyone understands. So, first of all, why is there 2 billion people that are unbanked today? There are essentially two issues. One is that they are out of reach of these points that Uday mentioned, ATMs, bank branches, or they don't have access to the internet. So they are out of reach of the traditional banking touch points. As a matter of fact, sometimes an average poor person may actually have to travel a whole day to get near one of these. So that's problem number one. Problem number two is that obviously this segment of the population is not well served by the banks, the traditional banks, who actually never engineer their products and services to be adapted for these. So that's kind of one perspective. The second thing that's important is that even though they are remote to most of financial access points, the 90% of the 2 billion people we talk about are in a reach of a mobile signal. And in excess of 80% of these people have cellular phones. Mind you, they don't have smartphones. They have 2G phones that have call and text capability. But these are actually adequate instruments for having access to a transaction facility. So this system, mobile money that we mentioned, I just want to make sure you understand it. This is a system where I can send money exactly like I send a text message. And if you think about it, we don't have that here, in fact. So in some ways, this is a more advanced system than what we have here. Anyways, before we continue, Uday mentioned that Bill Gates spoke at Cybos 2014. Let's hear him again, what he had to say. Can you cue the video, please?
There's no place that digital technology can change more than making payment systems, making digital transactions very, very inexpensive. And so we decided to put a lot of our investment in working to accelerate this digital payment platform. So we think digital payment systems can do more for equity in poor countries. The financial service will connect into your overall identity store of information that you use as you roam across these different devices. So they offered this service starting in 2011, and now they have over 13 million customers, and 22% of all the adults are connected up, and the adoption is on a very, very fast curve. So far, it's at 10% of the GDP of Bangladesh, about $1 billion of business a month that's taking place there. But that's just the bootstrap. The first generally 3 years, it's mostly used for money transfer. But then very quickly, the merchants realized that they could directly accept that digital payment, and it would avoid a lot of complexity for them. Now there's value-added applications, including savings accounts, short-term loans, and the demand for those products is very strong. We had an insurance example where a crop insurance had been purchased that if the rainfall exceeded a limit where there'd be fairly extensive flooding and the crops would be damaged, there was a known payout. So just right there on the cell phone, everyone in the economy, no matter which cell phone operator they use, is able to transfer money to each other. We'll have 2 billion new people coming in to the formal economy. That's an amazing thing. And make the idea of assessing a credit risk against somebody far more straightforward and draw people in. And so we're looking forward to partnering with many of you to make this a reality to help lift up the world's poor.
So I'm going to ask you a question, Costa. So that was 3 years ago.
Yeah.
Have we made any progress?
So yes, so we have made considerable progress. First of all, what Bill was referring to, the system in Bangladesh is called bKash. It's a little bit comparable to M-Pesa in Kenya. And these systems have been growing since 3 years. In fact, today, across Africa and Asia, there is more than 90 instances of digital financial systems of that nature. According to GSMA, 90 plus, I think they process in excess of 40 million transactions per day. So there was quite a lot of progress. There was a lot of progress since then in India as well, in terms of financial inclusion. Now, the issue we face today is changing, and it's moving to a different level, which is the following. So most of these systems, with exception of India, most of the mobile money systems today are closed loop. So you have to be, both the sender and receiver of the transaction need to be part of that same provider. And it's kind of, if you think about this, if you compare this to mobile phone capability, it's kind of strange. You can now call pretty much anyone from your mobile phone, but you can't yet send money to anyone. And so where we are today is the need for interoperating all of these systems, the digital financial systems, between them, and then interoperating with the banking system, so that if a person in a poor household, so if she receives a paycheck from a bank, from her employer that has a bank account, she can send that money using mobile money system to her family. But if she wants to pay her school, it's another payee that needs to have a bank account. So the next step is really to make all of these systems interoperable, which will appeal to more customers to come in and therefore put more volume on these platforms. And we know that these platforms work by are profitable as the more volume you put on them. So this morning, we at the Gates Foundation, following Bill's speech, we have put in open source this morning a software that we call Moja Loop, that is software that is free for anyone to use to make these systems interoperable. So that's one type of progress as well that happened since then.
Fantastic.
Yeah. Let me just very strongly endorse what Costa's saying. The key here is interoperability. The topic is increasing the pace, and I think to go to the next level, it's not enough to provide financial services for the poor. Yeah. It actually needs to be integrated into the broader economy. We need to bring those two economies I was talking about together, and interoperability is the key. Now, technology is a big part of that, and the open source software is a great contribution. But it's actually a governance challenge. It's actually about how you get all those different business interests. Telcos, retailers are very big in Africa in terms of money transfer, banks, and then the central banks and the governments, how you get them to come up with a common sort of framework for doing that interoperability.
So Chris, India cracked it, right? Yeah. And they cracked it by
1.2 billion people in one country. That's
So UPI, right? Universal Payment Interface
is a real-time interoperable platform.
Real-time interoperable platform. You can move money from any bank account to any bank
Right.
account. And interestingly enough, as a result of UPI, actually, I don't see a future for wallets and mobile wallets in India.
Right.
Because actually what's going to happen is everybody's going to end up with a bank account, and they're going to use that as the core where you hold it. And I actually have a philosophical issue with telcos getting into mobile money without having banking licenses, because philosophically, if you think about it, when you put money somewhere, you want it to be protected. How do we protect our money when it's sitting somewhere? If it's sitting in a bank and the bank goes bust, there's typically something called deposit protection insurance,
Sure.
where the government will step in and give your money back. And guess who funds that? It's the taxpayer. So I think it's, there's a whole question mark on that, and I think that's quite an interesting point around how you end up. But I think that that's the evolution. So where you're sitting in South Africa, where do you think that's going to go?
So-
Because you sit in a market that's kind of both, right?
Yeah, exactly. So I think the really interesting part about this is not just that we need to find a way of integrating those two things together, and there's a lot of work going on around that in the Southern African region at the moment, but it's also that the effect of doing that will change banking as an activity.
Yeah.
Right? This is actually a very important part of this as well. So the traditional idea of African banks serving the banked part of the community and kind of leaving the rest alone, with the pressure of having to interoperate to be open loop with mobile solutions and with new entrants, is going to force those models to change quite rapidly as well, and so that you start to get that sense of interaction. I think that is probably the most exciting thing that can happen in Africa right now. And remember, we're talking about whole of Africa, 55 jurisdictions, 1.2 billion people, a great deal of complexity. And just in my little world of payments, the stuff I wake up every morning thinking about, I know everyone else doesn't, so apologies, but I'm a payments geek. So if you think about the three biggest economies in Africa, you've got Kenya, Nigeria, and South Africa. They all use a different form of a real-time convenient payment. One's card, one's electronic, and one's telco-based. Right, so that's actually quite a big challenge. How are you going to interoperate across a jurisdiction like that? Right?
And I just wanted to add another dimension which we see happening. That's another huge change happening as we speak, is we are starting to talk, in the search of volumes, we are starting to talk regional payment platforms, not only domestic ones, but actually regional. SADC is one example. Western Africa is another example. Eastern Africa. So this integration happens not only within a country, but more and more on a regional basis, which I think is happening as we speak.
Yeah, and there's a great report that Visa publishes on that, about the regionality of how Africa is becoming more and more regional as we go.
Yeah.
I think maybe just on that, maybe just to turn over to Patrick, because that's a slightly different approach to the problem. So,
Absolutely. And I think we've got a short video to start with.
Greenlight Planet introduces SunKing Easy Buy technology that makes off-grid solar energy affordable for millions of households living off the electric grid. SunKing provides bright, abundant solar light, helping families to be safer and more productive after dark. Our products remove the need for smoky and dangerous kerosene lamps and help families power the devices that keep them better connected and well informed. So why do 1 billion people still use dim kerosene lanterns at night when they can access alternatives? The challenge is in the upfront cost. By removing this pay upfront barrier, more than 1 billion people living off the grid could say yes to cleaner, brighter, and safer light. SunKing Easy Buy makes the concept of pay-as-you-go pricing possible. It allows customers to take a SunKing product home without a high upfront cost. For as little as 25 US cents per day, families can now afford to say yes to SunKing solar energy and a brighter, safer, and more productive life.
So Patrick, what does solar have to do with what we're talking about today? I sense a lot of confusion in this room.
So I guess, to start with, it's interesting that this problem of access to energy, lack of access to energy, really goes hand in hand with the problem of lack of access to finance. They're very similar in that, if you don't have access to energy, you don't have access to education. The kids that you saw in that video are, they're in a family where parents are often faced with a choice between paying money for kerosene or paying money to put food on the table that night. And that's a choice no family should have to face. The kerosene lamps and fuel-based lights are terrible for people's health and safety. And without access to energy, people don't have a way to improve their livelihoods overall. So these problems go hand in hand, and we started working on providing off-grid energy solutions back in 2008, 2009. And I think there are kind of three things that you need to solve this problem. The first one was the products, just the hardware. So thankfully, solar technology and battery technology has been improving to the point where now we can not only provide a solar-powered light or a solar-powered home system that's more affordable than kerosene, it's actually more affordable than the electrical grid. So even if you have a power line running right by your house, it's typically a few $100 to $1,000 in, say, rural Kenya to get connected to that power line. And then you've got to deal with maintenance, you've got to deal with, some cases, corruption. So we can now, for a couple $100, provide a solar home system that powers all of the small-scale appliances that people demand in rural areas. So all of that energy forever, or essentially forever, at a lower cost than just getting connected to the grid. So the products were the first part of the challenge, and then the second thing is distribution. We found ourselves having to build all kinds of infrastructure, not just for the hardware, but to get these products to market, to explain them to people, to provide the after-sales service in rural areas that just wasn't available. But then the third component of it turned out to be financing. So even if you have a great product and explain it to the consumer, and you have a support system for it, the fact is, a solar-powered energy alternative has a higher upfront cost than a day's worth of kerosene or candles. So we had to figure out a way to solve that problem. And until just a few years ago, the only way to do it was with traditional, finance. So, or slightly, non-traditional finance like microfinance products that, are just not available to everyone, unfortunately. But now, with the growth of mobile money, we have this new mechanism that's allowing this to really take off in a big way, and we can collect payments over time, and we can build a history with clients to understand whether when they're able to pay, and it's solving the problem globally. So we've lit up the lives of over 25 million people so far with Sun King products, and we're planning to not stop until we get to all billion who need these products.
It's actually mobile money and real-time payments, right? So
Yep.
it's not just it's the ability to move the money to you and like you become basically the first touch point for these people of a financial service that brings them in. And we were talking, this is the idea of contextually based financial services. We don't wake up in the morning and say, hey, it's a good day to open a bank account, it's a good day to get a loan. We think about, I bought a car, so I need car insurance, or I bought a car and I need financing, so I get a solar panel, I need to finance it, so I need all the infrastructure around it, which is mobile money, moving the money around, and then you can build credit behind that. And we were talking about other ways of getting credit in these markets, and that's how you build your credit history in a place that doesn't have credit. So
most of these are unbanked consumers, and oftentimes this is the first financial product that they're getting access to. And so, we're looking at going, of course, after people pay off their solar home system, we can offer additional products, whether they're pay-as-you-go enabled or not. So the thing with the solar products is if the security element of it is that if people don't make a payment, the product turns off. So it's a way of providing sort of a semi-asset-backed type of financial product. And having the sort of automated ability to control access to the product if people stop paying. But after people pay off the product, we can offer a range of products and services using that same pay-as-you-go capability. So yeah, we're looking at a range of products, and it's interesting how in some of the frontier areas, the demand for solar energy products, like you said, is actually driving the demand for mobile money, for real-time payments now, and the interplay between these is really interesting.
So then maybe over to Chris. I mean, how do you think about this? How do we build this out? And talk us a bit about what you're doing.
Okay, so let's start with the sort of real-world example of the kind of stuff that can be done. What you're seeing on the screen right now is a series of grabs from a very successful financial inclusion payment program from South Africa. So about 3 or 4 years ago, the government decided to automate the distribution of social welfare grants. And in South Africa, they're a big deal, right? Something like 17 million people eat because they get paid by the government each month. And without that money, there would be serious lack of food, there would be serious problems. So it's a terribly important part of the economy. And starting with a card-based program, progressively, all of those social grants have been automated. Now that's a really big step forward. We've taken the banking rate in South Africa from 59% to about 77% through the introduction of this program. And yet, it's not enough, because the way this has ended up working is each grant holder now has their card, and at Bank South Africa, one of the things we do is run the ATM network in South Africa. So what we see every month on the first of the month when everybody gets their grant is this enormous spike in ATM payments, right? So what's happening is they're taking the card to the ATM and taking out the entire grant in cash and then doing what they used to do with the cash. So they're not getting the full benefit of the financial inclusion potential of the card. The card is a full function item. You can walk into a shop and pay using it, except that typically where the grant recipients are living, you're going to struggle to find a shop that will take a card, right? So there's a first challenge. The second challenge I think here is that the literacy, the protection elements that Uday was talking about are not really there with this program, right? The people have worked out how to get hold of their grants, but they're not really, I think, being given the opportunity to use the full potential of the thing because of the education challenges of rolling that out. So while I don't want to take anything away from the program, I think it's been incredibly successful. We need to now do what we were talking about before, which is the next step of how do we integrate that back into the broader economy.
So maybe the question is, so how do we move from what is, albeit a successful financial inclusion program, to full integration across the economy? How do you do that?
Okay, so the trouble is this is a much bigger problem than, as challenging it is, than providing a specific financial inclusion program. So if we could have the Peacock slide up, please, and I'll talk a little bit about it. So this complicated looking thing is the result of a 10-country study that we've just completed in South Africa. And you can get the full report off the web. If you go to banksouthafrica.com, you can get the full report. There's 300 and something pages of it, so you're going to have a strong stomach, but by all means. But what we're trying to go to here is how do we structure the incentives around general payment system development, so that they fully include the underbanked community, so that as we rebuild the next generation of infrastructure for developed economies and developing economies, we think about the financial inclusion element. So what you see here is the 10 goals that are most likely to be adopted by various countries as they modernise their payments architecture. Not specifically about financial inclusion, but you can see that one of those key goals is financial inclusion, which supports Uday's observation that it is a leading policy priority of most governments today. Turns out, though, it's a very complicated problem. I guess we kind of knew that, because all of those levers down the side, the different things you can do to do something about reaching the goal, nearly all of them are in the financial inclusion space. So to do a full job on bringing the underbanked into the full economy, there's an enormous amount of different levers you're going to have to pull. And yet, there's a kind of an opportunity now to do that. And the reason why there's an opportunity is because all around the world, both developed and developing economies are moving from batch-based systems to real-time rich data systems. That's happening in different ways all around the world. So the big chance is we can use that evolution that has to happen anyway to do something about financial inclusion.
Okay, I'm conscious we want to leave a bit, so I'm going to take questions from the audience. So, and if you don't have questions, I'm sure we have quite a few more questions. Any questions? No.
Somebody?
There's one there. There we go.
You talked a lot about financial inclusion in developing countries. What about developed countries, rural areas? What's happening there? What are the opportunities? Are there things that financial institutions and local governments can already do now?
Let me start with that, and I'd love to hear everybody else's view. I think that absolutely there's a lot that they can do now. Here's the conundrum, and that something that Chris just said here, very, very important. Where the developing countries have made great strides in attacking the financial inclusion problem is being to take out the biggest point of friction, which is moving money around. Because if you can create electronic money and you can move money from A to B to C at almost zero cost or zero cost, you pretty much solve the financial inclusion problem, because then you build a whole infrastructure on top of it. Now, I will also say that there is an entire gigantic flaw here at Sibos, whose entire business model is about creating friction around payments and making money off those payments. And that's where the developing market...
Taking advantage of friction, I'll allow that. Creating friction.
Taking advantage of friction. Thank you, Chris. And so you have this bit of a conundrum, and this is where I think the problem in developed markets has occurred, because you have infrastructure that frankly supports a price point, but below that price point, and maybe you had some thoughts on this.
Yeah, sometimes people think Canada has solved a financial inclusion problem, and we actually haven't, as great as we are. And it's because we have an Aboriginal population way up north, and I was just in Nigeria a couple months ago, and I was talking about AI and fintech and blockchain, and at the very end of it, and how great it would be for a Nigerian. At the very end of it, some guy at the back stood up and he goes, well, Christine, actually, we don't have internet in a large part of our country. Like, duh, of course, stupid comment from a Canadian. But in our own country, though, out west, up north, a lot of people don't have internet, the same issue, and you wouldn't think about it, but because they don't have internet, because they're in really remote areas, they don't have banking, and they also don't have banking because they don't have the perfect ID that you might need to get a bank account. So it comes back really to, as you were saying when we started this discussion, identity, and what do we mean by identity, and why do we insist that it be so absolutely perfect that a bank has to, ID you to death when your neighbor knows who you are, your mom knows who you are. Like, there are communities where you're never going to get a stranger coming in, but why can't we bank those people because we know who they are, because they're part of our community? So I really do think we need to rethink identity and rethink the whole idea of what the legal impediments are to financial inclusion, including in what we call developed countries like Canada. We could be a leader and solve it in our country and export the solution everywhere else.
Question there.
Yeah, thanks. 2 points. One, I think SASA in South Africa, right?
Yeah.
Yeah. I think in the United States they have something like EBT cards, which is virtually the same thing.
Yep.
Question going back to the panel: how do you deal with the charges that the mobile operators charge? It's not just banks that need to make money for providing services, but mobile operators as well do, and that can be a serious impediment. Nobody's talked about that yet.
I completely agree, and in fact, I agree so much. I think people often talk about M-Pesa, and you're running on M-Pesa, but I don't think people realize how expensive M-Pesa is for the consumer to move money around. And until Equity Bank in Kenya put its hand up and said, this is ridiculous, and the only way that they could compete with M-Pesa was to set up their own virtual mobile network. So they've set up an MVNO with Airtel, which is EquityTel or whatever it's called, Equitel. And they are now competing against M-Pesa to bring down that cost. And you're 100% right. Now, the reason that friction is being created is exactly what Costa talked about. The reason they can create it is that when Safaricom launched M-Pesa, or it accidentally launched, because actually DFID who launched it, but accidentally launched M-Pesa, they had an 86% market share of Kenya from a mobile. So they built a closed-loop network where they effectively had a monopoly, and by keeping it closed-loop, they can charge these users fees. And then, so
But I think, it's the same point we were making before. Interoperability of the platform is going to be a key part of this because it opens up that competition. Banks, MNOs, retailers, they can compete for this business. That is what's going to drive the cost down sustainably over the long term. So trying to do it at a sort of a regulated end is a bad idea. We really want to create an environment where that competition is managing the cost base, right?
Yes. And I would just add one point in addition to all that was being said, but if you look at the bottom of the pyramid, as we say, population, there is actually a lot of nuances there, and interoperability also favors offering the right product at the right price. Part of it is incentivized by competition, but part of it is incentivized by the need of the poor as well. So creating this rich interoperable offering is going to drive the market to the point where it needs to be.
Questions? No, there's some at the back there.
Hello. So I have a question. Is there a study that exists that has examined what the cost of lack of identification is on economic goals? Is there a study of that nature?
I'm sure they've done it in India, but
Let's do one.
I can't think of...
Yep.
We'll do one.
Yeah. If there is not one, we need to do one.
Well,
but I have the feeling there is. I just can't remember it or point to it right now.
Well, don't leave me out of the opportunity while you decide to do one.
All right.
Thank you.
You're in.
Sorry, question there.
Sorry, thanks. Related to both the identity question and the inclusion question and the banking question, I think underlying a lot of what the discussion has been is the assumption that everyone will need a bank account. What happens when fintechs develop things that are like M-Pesa but better, and as M-Pesa has done with payments, leapfrog traditional banking?
Yeah. So I'm really glad that you asked this question, because today, in fact, the mobile money systems are actually not bank accounts. They are wallets, and they have quite different characteristics in terms of the functionality, but also the price to operate. So I think that's already quite a very differentiated offering, but we are not done. I'm sure that as the number of providers increases, that we will see other type of offerings as well, that and the price, in fact, the goal of this whole thing is to move volumes on the platform so that the price per unit becomes very, very low.
Yeah. So I was just going to say that actually where you need to look at I think there is a much further advanced place that's China. And so why do I say China? Let me run you through why China, right? So China is dominated by Weibo and a bunch of, Alibaba, Weibo, others. So your average Chinese consumer will have an Alibaba wallet, or will have an Alipay wallet, or a Weibo account. The biggest asset aggregators today in China are not the banks anymore. In fact, they are these networks. The world's largest money market fund is out of the wallet that people have in Weibo, and then they put the money into the world's largest money market fund in China. So that's the starting point. Now, let me give you the next point, because this was something. The next point is we've moved beyond the concept of a credit score in China. We moved to something called a social score. So for those of you who don't know, the Chinese government about 2 years ago put out a set of regulations, gave out 10 initial licenses to people to develop what's called a social score. The one that's the most advanced is a company called Alibaba, which has created Credit Sesame. Credit Sesame is more than a credit score, because actually it looks at your social behavior. So for example, if you criticize the Chinese government, they will pick that up and will lower your social score or your Credit Sesame score. If your score goes below a certain level, you can no longer fly outside of China. If it falls below a certain level, you can't even take a train in China. And I just want you to think about that. So this is the amalgamation of everybody having an identity, everybody having a bank account, and everybody now having scores that are not only attached to your financial behavior, but your behavior as a whole, which can take everything, including your social networks, the way you behave in your social networks, and everything around it. And so this is now starting to become quite a complicated topic that is going to become a real topic of discussion that we haven't seen. Sorry.
Yeah.
Yeah, I should come clean. I'm building a reputation-based financial system. But that is kind of my point.
Yeah.
It's already happening.
It's already happening, yes.
So why are you still assuming that banking is going to form the future of how finance works for the unbanked today, when we've already seen how solutions like Alipay and Ant Financial and all of these are leapfrogging traditional finance in areas with large numbers of underbanked people?
I'm with you, but there's a saying that says turkeys don't vote for Christmas, right? And we're in an interesting environment.
The other point is that's not. It's not necessarily the case that the bank account of tomorrow is the bank account of today. In fact, it's almost vanishingly unlikely that it will be.
In fact, it's quite different.
Yeah. So the idea that we all know what a bank account is and it's the thing where you have a passbook and walk into the branch, that's just not a bank account of the future. I think we just have to get used to the idea that if governments get their regulatory act together, they're going to be functionally regulating whatever store of value you're using in whatever digital form in the same way, regardless of who provided it, right?
And also, I think it's worth pointing out that we never talk about financial inclusion for businesses, which is also an issue. And when you talk about blockchain and ICOs, like the next biggest thing that's in the news every single day, those digital currency exchanges often cannot get bank accounts. And so here they are with the opportunity of providing a whole group of people all over the world with a way to move money that takes them completely outside the banking system. But those companies that support that can't get bank accounts. And unless those underlying entities can get bank accounts, none of the 1 billion people you're trying to give financial services to can be assisted. So we do definitely need the banks on board to help us move with new financial technology, or the whole thing just won't really go anywhere.
Okay, unfortunately, we're out of time. I've been told we're out of time. So let me just, a couple of housekeeping points before I thank everybody here. The next InnoTribe session is at 6 p.m. It's Rethinking Cyber. There will be cocktails afterwards for those of you who need an incentive to stay. The other thing is that please do donate to the Mexican Earthquake Appeal if you're having coffee, or if you're not. There's a little kiosk next to the coffee to put your donations in. That would be great. We would love you to rate this session using the feedback columns on the way out. And with that, I'd like to thank the wonderful panelists here who've done a great job today.